Next panel doesn't need an introduction, and you have obviously a superstar coming up next, and finishing with Controller Gould, who's gonna lead us right into drinks. But when I started in this industry, there were a few people that you look to who are leading this industry. And founded in 2012, Upstart was talking about AI long before we were talking about it today. And not only were they talking about it, but they were doing it. And that was because Dave Girouard had the foresight, had the vision to create a company that really was at the foresight of solving some of the problems created in the Great Recession. And thanks to him, stealing Nat Hoops gave me the opportunity to get this job today. And so very much appreciate Dave for so many different reasons. And of course, his moderator needs no introduction. Peter Renton has been doing this, again, a lot longer than I have, and probably much better than I have. So guys, come on up here.
Good afternoon, everybody. So, yeah, as Phil said, my name's Peter Renton. I've been around fintech events for a long time, been following Upstart pretty much from the very beginning.
I was following you before I founded Upstart. I mean, you were around a lot longer than Upstart was.
Yeah,
right?
I started in this industry in 2010, so that was quite a few years ago now. But let's start with, I'd be curious to know, so you became a public company almost 5 years ago. What have you learned in the last 5 years as the CEO of a public company?
Well, wow. At least I don't have to meet with venture capitalists anymore.
Investment bankers you have to do.
Yes, investment bankers. You know, being public, I think it's a great thing. It's been a very, if you don't follow Upstart or our stock, it's a very much been a roller coaster ride. But I think being a public company is the place you want to be. It's what someone else has said, like, if you're a football player in college, you want to play on Sundays, right? You're not American, I get it. But
I've been here 34 years,
Dave. You want to go to the NFL. It's like, it's the destination you want to get to. It's the, you know, so I think it's a good thing. It is very hard, and you know, you have to have a fairly thick skin, and you have to be ready for ups and downs and everything. But to us, you know, for somebody like me, like a 13-week cycle, which is just what you operate in a public company, like I like it. I think more companies should go public. I hope that regulators and lawmakers will make it easier to go public and less costly to go public. I think it's kind of a shame when these huge successful companies, typically these very large tech companies, stay private so long. So I think it's a great thing, and it also just sort of it requires the best of you, you know, just to sort of achieve what you're trying to achieve while dealing with the quarters and investors and the public scrutiny and all that. But it's a wonderful thing. I have no regrets at all.
Right. So let's dive right in to AI, and because as Phil mentioned at the start, you guys have been talking about AI for many, many years before pretty much anybody else in the lending space was talking about it. You've been using you know, machine learning in your underwriting from the very beginning, from what I gather. But I want to differentiate between the AI that you've been using and the AI that has sort of been popularized in the last 3 years, starting with ChatGPT-3. So tell us a little bit about you know, how you've been using AI, and how is that different to what has become, you know, the generative AI phenomenon that we see today?
Sure. Well, you know, AI and machine learning are areas of academic research for many decades, and they are all they come from the same tree. They are all similar in nature, things like neural networks. And so it's not so much the core technology is different or whatever, but I would just say they're very different use cases for AI, and it takes the technology in different directions. So for example, just to put what we do for a moment aside, you have things like drug discovery, or you have things like autonomous driving. They're very pinpoint, very specific things you're trying to use, problems you're trying to solve with AI. We fit in that class. We're trying to solve a problem of risk management and credit origination, and it's a very specific problem. So it still has the same thing. You have training data, you have algorithms, you know, you sort of keep iterating. The machine is learning as it goes, as the data gets thicker, et cetera. So those are all in common. But what really, of course, blew the door open is a large language model. Now what makes that so fundamentally different, and why it's the topic du jour, is that it's trying to solve an infinite number of problems at once, a generalized problem. That's why you can go to ChatGPT and ask it about virtually anything in the different places it'll take it. So it's language-based. It can really generate content that didn't exist before. That's what makes it very unique. Now, it's all AI, but I guess I would just say in some sense we're indebted to the fact that this experience that anybody could have starting back in the fall of 2022 when you would go to ChatGPT and say, wow, I can't believe it just did that, this is just incredible. Like that's opened up everyone's awareness of it, but the technology has been out there in many places for a long time. And we have really, since the earliest days, I mean, when we started, we were trying to help underwrite thin file people who had very little credit history, so trying to draw on other forms of data to make an informed credit decision. That was somewhat the simplistic idea we started with, and as we just kept growing and adding different types of data and different types of products, and you went from sort of a linear regression to a nonlinear world, and suddenly in about 2017, we said, this really is AI and machine learning, and we should start calling it that. And then a lot of people said, God, don't call it that. Nobody will want to work with you. What a terrifying term. And it was true. It was like the banks and credit unions and all that we were partners with. It was to take a step and say, oh, we're doing AI here. It seems like not the greatest thing to bring to the forefront. But I think we kind of felt we knew where it was going and that the world was going in this way. And we said, we'll be the ones to advocate for it in this particular domain.
Right. And then you had earlier this year what you termed your AI Day, which was an investor day, I take it. And at that, I was watching the video that of your opening remarks there, and you talked about how that Upstart was a misunderstood company. And what did you mean by that? And did that day really help people understand Upstart better?
I don't know. I'm sure I said misunderstood. Maybe I just mean undervalued. No. No. I think that what I really meant to say is there are plenty of non-believers in our business and in the nature of what we do thus far. Now, I will just generally say some of that is things we could have done better. Or, what we're trying to achieve in the use of artificial intelligence and machine learning and credit is a very long road. A lot of things have to be proven, and they have to be proven in different environments. And we have to make sure all these negative, bad things that any smart person would be worried about are considered. So, I say misunderstood in that we started out down this path knowing that this will take a long time to prove to the world. If we were perfect, had perfect hindsight and knew what to build at the beginning, of course, it could have been faster. But realistically, when you're building autonomous driving, if your car goes off the road, instant feedback, right? So as many cars as you can put on the road with the software and as many miles as you can drive. But of course, in credit and lending, months have to go by, right? You have to see full maturity of loans and that kind of thing. So there's just a lot to build, a lot to do, and then time has to go by. But I feel that we are really getting to the point where it's very obvious to us, and maybe less obvious to the world, maybe that's okay too, that the whole industry will go in this direction. To have the idea that you're going to make risk-based decisions, put millions or billions or trillions of dollars at risk without using the very best, most accurate risk models you can, of course, would be crazy, right? And just like in any other domain, AI is going to, and it's not as interesting as like, replacing human effort or whatever. Lending has mostly been done by computers for a long time. It's just that you are going to want the model that is most able to separate good risk from bad risk, to calibrate itself very quickly to any change that's going on in the greater environment out there, deliver the returns that you want, only take the risks that you can afford. All these things together done in a holistic way and done very precisely. I mean, that's what AI offers to lending. And ultimately, on the other side, of course, it means a better product, right? In the prior session, the moderator said, what does this look like in 20 years? In my view, credit and lending, banking in 20 years is like e-commerce 20 years ago, right? Everything, it's going to be what you want it to be, first of all, because you as a consumer are going to get what you want. And that generally means if you want it on your phone right now, you're going to get it. Whether that's Amazon or Uber, you're going to get it. And if you want to go talk to somebody, you can do that too. And maybe it's a real person, maybe it's not a real person. But I think mostly what consumers want and what consumers expect drive everything else in the industry. And I think that's what we can expect.
Right. Okay. So the title of this session is Opening the Algorithm, and where AI meets open banking and smarter underwriting. And one of the things that we were chatting about when we chatted a few weeks ago, you said that the explainability piece, it was a really big deal, like in the late 2010s, right? The whole explainability of you had this black box AI underwriting model, but you said that the concerns there have largely been, it's been resolved basically for the most part. Does that mean that you've kind of what you've done is really cracked the code of making these things really transparent, or what? How has it been explainability been resolved?
Yeah, a few weeks ago, I'm watching CNBC, and the CEO of FICO is on there, and he was talking about this whole deal. They were getting pressure from the administration, all that stuff. Anyway, the host basically says, "What about AI? Is AI going to work in credit and lending?" And he goes, "Oh, no. You can't do that because it's not explainable." And it's like, wow, he took all of like 8 words to dismiss my entire life. But truth be told, like that's one of the first fears people have is, oh, it's a black box, and that's not acceptable. Given the history of fair lending and credit, that explainability is a must. And the truth be told, there is technology, and we have developed technology that essentially will say, of all the many things going on in this algorithm to help determine whether this person is creditworthy or not, which ones are the dominant ones, and how can we summarize them into a human understandable piece of advice, if you will, to the applicant, if you're declining them, if it's an adverse action notice. It's just as important, by the way, to be able to say, why is this loan more expensive than that loan, even if it's not a decline? So legally, of course, you have adverse action notices. You have to deliver those notices. We do it always the best we can in a meaningful way. And just saying your credit score was too low isn't terribly meaningful in terms of knowing what to do next. So we try to make them actionable. But it is really part of the data science that you can both ask the machine for the answer, and you can also ask for what were the major things that drove that answer. They're referred to as SHAP values. And I don't remember what SHAP stands for, but it's a science. We didn't invent it, but we had to do a lot of work with it to deliver it. So long and short, there's no reason to believe AI can't be explainable. Frankly, even better than in a traditional lending system, I believe, if it delivers actionable, sort of information for the consumer.
Right. So let's get to the second part of this session, and that is the open banking and smarter underwriting. So how is Upstart using open banking today, and how is that helping your underwriting?
Well, that's kind of a broad term. I mean, I guess I think of it as the idea of AI in underwriting is there's a lot of ways to prove that somebody is creditworthy, and they aren't all a 3-digit number. And generally speaking, the more types of data you can have, rich data can help you identify more people that would be creditworthy that you otherwise would think otherwise are not. And so, for example, I'll just give you an example. If somebody is working in nursing, okay, you'd be like, well, great, that's wonderful. They have a certain salary, whatever, but the system might know actually nurses are almost never unemployed, right? There's a perpetual shortage of nurses. So all in all, everything else being equal, being a nurse generally is a good thing for creditworthiness. Now that's just a single idea, but that's the idea is when you have more and more data, you can find more ways to prove somebody's creditworthy. And the net of all that is if you look at a system that we built compared to a sort of traditional credit score based system, you have radically higher approval rates and lower APRs. And that's just truth. You have to say all else being equal and what is the traditional system and all that. We worked for many years with the CFPB to actually not just prove that the system was fair, which is another whole area, but to prove it was worthwhile, that it was actually doing something that the market could benefit from. And by the market, I mean both consumers, which the CFPB cares about, and lenders, which a lot of the other regulators are essentially focused on.
So are you using cash flow data today when you're underwriting?
Yeah, it's funny. We hear so much about cash flow data, and we're just like, oh, that's like column 25 through 8,066. Like, it's just data to us. It's not, the only trick about data that you use in underwriting is every sort of step you require the consumer to take, you lose more of them. And cash flow data, which typically, you would sort of provide a link through Plaid or something like that to your bank account or something like that. We don't typically do that at a first run because we can do a better job and end up approving more people, leaving that to a later stage, or also using it only for certain people. So long and the short, cash flow and it's such a buzzword term in the sense that what do you really mean? Well, what are people spending money on? How do they make money? How does that balance out? How does it happen month by month by month? And kind of seeing that, I mean, it seems fairly obvious. Geez, that not too hard to guess that would be useful to understand somebody's financial credit worthiness. So yes, we do that for sure. But again, I don't view it as a special class of data. It's just, it's a giant, obvious group of data that any underwriter would, of course, should be using in some way.
Right. So let's switch gears to policy. What are some of the important policy questions that you're grappling with or you're driving for right now and into 2026?
I mean, there's a lot. I think the push and pull between federal regulators and states is always a thing, and where that goes, especially for somebody like us who operates not today as a bank or a chartered institution. And so I think we're always on true lender issues, Madden issues, this DITMA opt-out stuff. So there's just all these things that I think are in the center of policy. I should say, like, these are small things for us in the sense of they're just like little stuff we have to deal with. We went through such a long period of time where the fear in our business and about us was fair lending. Like, we were using new data, we were using new techniques, and we were making credit decisions. And ECOA laws, from the 70s would say, be super careful when you do that. And if you asked me this question 5 years ago, it would be like, oh my God, fair lending Monday, fair lending Tuesday, fair lending Wednesday, because that was just where it was. And I think even before it, and we did this through 4 administrations, just so it's clear. When we started and we first got a no action letter from the CFPB, it was really coming out of the Obama administration, the very end of that, into Trump 1, into Biden, into Trump 2. So it's like we've dealt with all forms of or all sort of leanings in terms of regulators, but it's always been the same thing for us. We've kind of won the battle, and twice I've gone to the House Financial Services Committee and testified, and the numbers are so jarring when you see how much better it is for consumers to use AI in lending in terms of credit access, that everybody just goes, well, that looks pretty good. I guess we should be doing more of that. And so we don't have, we don't have the hotspot issues we had, 4 or 5 years ago, or more than that even.
Right. So when we chatted, you also said that 95% of your work to date has been about making predictions better. Pricing loans, avoiding fraud, automation. But you said the future is about impacting outcomes, which I thought was an interesting way to put it, not just predicting them. So what does that shift look like from predicting to impacting outcomes?
Yeah, this is I think the basis of our business has always been about predictions. People show up and you're going to predict, are they who they say they are? Do they have the income that they say they do? Are they going to pay back the loan? So it's all predicting. And you do touch into the affecting when you become a loan servicer, of course. You're trying to help them make good on their debts and all that. So, but at some point, it feels insufficient. It feels like credit is this amazing tool, but it can be used horribly wrong, right? And you can always have these examples where credit was life-changing in the most positive of ways, and where it was abused in the most horrible of ways. And when someone would bring that up to me, I always would be like, well, yeah, I mean, we ask them what they're going to do with the money. We can't really force them generally to do what we want. And a lot of people will take a loan and pay off their credit cards, and then they'll spend up the credit cards again. And so, you're in this sort of position where, we are predicting the outcomes. We're not affecting them like we would like to. Well, in the new world of large language models and agents, I think you can do a lot more. You can really help somebody think through a problem. And I don't think we're not gonna become a nanny state of like whether you get a loan or what you should do with the loan, but we might be able to help people on the margins make smarter decisions. Is this a smart thing to do? If I bought my house and I want to remodel my kitchen, is this a smart thing to do or not? Is it likely going to be a financially good decision or bad? If I'm going to do it, how much should I spend? Where might I get that money? So things that we never do today. We're kind of at the end of the road. And there's websites and there's advice and there's this and that. But I think that the new world of agents can have a really good understanding of who you are, what you've done in the past, what your financial situation is like today. And again, if you're open to it, helping you make a smarter decision. And that's when you begin to affect the outcome. That's where like somebody who shouldn't take this loan just won't take it. That's kind of like I think the new world is. And that's where I think this new type of AI that we all know about now, large language models and such, really can begin to shape people's financial futures in ways that are very constructive.
So then are you working at Upstart towards a world where not an AI agent is applying for a loan and not a human?
Absolutely, yeah. I mean, I've said to our team, let's like have a bet. What month of what year will it be when, it just, number one, it just happens, meaning they're just screen scraping and we're going, wow, that looks really weird, not quite behaving like a person. Or maybe it's OpenAI or Meta or Google or somebody says, hey, we would like to have our agents apply for loans on your system. And I'm like, okay, we better think how we feel about that, right? And my feeling is I actually would like to be on the other side of that. I would rather be on the side of helping people apply for loans in other places. So, but that's a future, right? I mean, that is, you don't have to draw lines too far into the future to see that those types of things are going to be readily available. I mean, today they're a little focused on less regulated, less risky things like making dinner reservations or buying something for you on Amazon or something like that, of course. But there's no doubt it will get to the place where it wants to help you do everything that's important to you. In this area where you're going to take on a debt somewhere, having some agent help you do it most optimally, of course, is a great thing. So there's nothing wrong with it. And I don't think this is 10 years out. I think it's 2 or 3 years out.
Yeah, what was the consensus when you went out and said when this was first going to happen?
We don't have a consensus. We all just argue about it.
Was there an average?
I think it's in the next couple of years.
Couple of years. Okay.
I do think. I mean, the pieces and parts are already coming into, like you can see how ChatGPT is now, you can now sort of start to do things in ChatGPT. They're opening up this API. So like pieces and parts of it are coming together for sure.
But then you said you want to be on the other side of it. But I presume you also want to still originate loans from whoever is actually applying, right?
I mean, sure we. I mean, we want to do whatever is best for the consumer ultimately. And if this brave new world's going to evolve, we have to figure out what our role is in it. But I think maybe the idea that you can passively just wait back for someone to either download your iPhone app or to come to your website and apply, that may be an inadequate approach to the market sometime very soon.
Right. Yeah, that is a fair statement. So, one thing you also said, I think it was on your AI day, you said that there is a $1 trillion opportunity in credit, and you had this everything store for credit vision. Can you just maybe summarize that real quick for the audience?
Well, we don't like to spend more time on doing little total addressable market slides than really is necessary. So we do a little search and we try to figure out, if you look around the world, how many dollars in loans are being originated every year. And it is something north of $25 trillion, maybe 30, something in that range. And it wouldn't surprise me if it's actually double that, but we could at least identify 25 or 30 trillion. And we said, look, if AI is really going to permeate all of this stuff, which we believe it is, and you can't just have a little AI. These are going to be very robust platforms. I think there could be quite a few of them, but there's not going to be an infinite number of them. And those platforms, if they're originating and servicing loans, I was like, probably could have a 5% take rate on that volume, and that gives you $1 trillion or so in revenue that, as far as I can tell, nobody has earned yet. It's all sitting out there to be figured out. And that's, OpenAI, that AI Day was our investor day. So we're just trying to help our investors appreciate the scale of the opportunity that's out there in this kind of interesting category.
Right. So then maybe we can close with looking out into, maybe it's beyond the 2 or 3 years that you just said, maybe 10 years in, how are people going to obtain credit in 10 years' time?
We have a view of what we are terming always-on credit. And what that means is every American could pick up their phone, or maybe it's some other device, who cares? Maybe it's through their glasses and above their face. And every form of credit that could matter to them is available in a click with no process. You're only onboarded once. It's there, and it is guaranteed to be the best price you could get in the market. So best price available, guaranteed, and zero process on your phone or at the edges of your glasses and there. And the only thing that you need to spend your energy on is making a good decision, not the process itself. And to me, that's where we're headed. There'll be a lot of thinking about money and where it goes and when to borrow it or when not to. But that stuff about paper and standing in line and reference calls to your boss or whatever it is.
Or even filling out an application form on your phone.
That will be gone, no doubt.
Okay, great place to leave it there. Well, thanks so much, Dave. It was great to chat with you today.
Thank you. Thanks, Peter. Thanks.